I want to talk about consumption with you for sure. And where is it that you are factoring in earnings growth versus plateauing of sorts? Because the street is very divided about what happens to staples, what happens to durables, versus what happens to select companies like maybe a Titan or some other, which are talking about strong growth.
So let's split it into two parts. You split it into staples and discretionaries. Staples, it's relatively easier to look at because they're far more stable companies. They are facing two headwinds right now, which is volumes, which are moderating, especially in rural India, and of course the hammering they've seen from input cost inflation. So if you're trying to look at from a very short-term perspective the performance of staple companies and their P&L, you will see a rampant pressure on their input cost because we've not seen any meaningful price increases yet. And so many companies are commenting, even today I read somewhere, that they are not looking to pass on entire cost inflation, given the weak demand scenario which is still prevailing in India, right? You've not seen any meaningful volume growth in the last 2 quarters, right? Now, if monsoon is good, input cost, moderates a bit, and farmer income, gets supported by some increase in MSP and in general higher food prices, maybe second half of FY23, which is always a very convenient way of looking at things because we always believe that second half will be better than first half. But let us see where it ends up, because right now things are a bit wobbly. The only thing which is working in favor is that staple stocks have underperformed a lot for last 3 years. And I was looking at Britannia, the price of Britannia today and the price of Britannia in July 2018 is the same. Well, earnings are up 70-80% in that 4-year period. But the problem is the starting valuations, which were at 65-67p. So even after 70-80% earnings growth in 4 years, the P's are still slightly expensive. You looked at Hindustan Lever for 2.5 years, the stock has gone nowhere. Godrej Consumer for 5 years, the profits have been flat, the stock has been flat, right? So the underperformance has been happening for last 2-3 years, depending on which stock in the staples basket you look at. But from a short-term point of view, this can continue in my mind, in my view, because one of the things has to change. Either the input cost has to correct sharply, or the demand environment has to recover, in a far more significant manner than what we are currently hearing. Right now, we are still hearing corporate commentaries talking about weaker demand for the month of April, and May was even weaker than April, right? So maybe it is a good time to accumulate some of these stocks if you have a view of 3 to 5 years. But like I was telling you before we began the conversation, if you compare the trailing 5-year profit performance of a lot of these consumer companies, whether staples or discretionaries, and then juxtapose that with the trailing 5-year market cap performance, you will find that there has been a massive re-rating. I gave you a couple of examples. Asian Paint market cap CAGR 21%, trailing 5-year profit CAGR 10%. Pidilite market cap CAGR 25%, trailing 5-year profit CAGR 7%. Hindustan Lever 5-year market cap 22%, profits still very respectable at about 15%, right? So if the rate environment is changing, and we have to be very cognizant about that because 10-year yesterday crossed 7.5%, it does have implication on the near-term price to earnings multiples, whether we like it or not, right? While the long-term looks very rosy, if you can justify any price on long-term by changing the variables, but in the short-term, this sort of bond versus equity yields always matter. Then coming to discretionary, it is very divergent there. It depends on which segment you are in. For example, if you look at Titan today, the last 5 years they've grown profits at a 22% CAGR, right? And 5 years back, the management has said that they're going to grow their jewelry revenues at 2.5 times in 5 years, which they have done. And now they're saying for next 5 years, we will repeat it. So which is a very ambitious and a very confident sort of a commentary, I would say, given the kind of environment that we find ourselves in, right? So therefore, in some of these segments, your valuation may not correct. Ideally, they should, but given the commentary, given the performance, and given the lack of competition in some of these segments, people would be comfortable owning it if they have a longer-term view, right? It's an expensive stock, no doubt about that, but just that relatively within that segment, its performance has been outstanding on earnings delivery. Then you look at some of the retail companies, the likes of Trent, ABFRL, V-Mart. Depending on the geographies and their consumer target segments, their performance will differ. But they've also seen some sort of a deleveraging. ABFRL has seen good deleveraging in the last 2.5 years through some capital raise that they've done. The other segment where we are very confident and positive is QSR. It's a beneficiary of COVID in our view. We basically feel that it's given a tailwind to QSR because the propensity to consume hygienic branded food during that 2-year period has increased. And given that 25 to 30% of the mom and pop restaurants have shut down, if you go by the NRAI data, the obvious beneficiaries is the QSR segment. And therefore, you're seeing significant upping of guidance in terms of store opening, because many of these companies are realizing that this is a good period for them to capitalize on the opportunity. So Jubilant is saying 250 new stores opening. That is one segment where we are very positive. We now cover all the QSR stocks. So Jubilant is something which we like. We like Sapphire, which we've just recently covered. So discretionary is going to be very segment specific and the kind of target consumer they cater to. But relatively, you might see discretionary continuing to outperform the staples.